Good morning, everybody. Good morning, Dunk. That's a new name for me. Nice to have you in the room. How's everyone doing today? I'm a few minutes early. Everybody got chatty, so I figured I would jump in and get going. Nice to see you guys today. Um, Welcome to the room. If you're brand new, welcome to the room. Um, it is, Rob, and I think that it's pretty common with everybody, especially when your short entry looks like it did on your small chart. You get ahead of yourself on the rules sometimes. You being a general term, not you specifically. We all do. We get so excited to be in a trade that sometimes we'll forego having all those advantages. Um, and that's it. Hey, good morning, Andy. Good to see you. That's the biggest thing is just being able to sit still when it's time to sit still. You'll get there. We've identified your thing though, and that's I think important as you become a trader. Is recognizing we all have a thing that we do. Some people jump in early, and some people jump in late, and some people trade into areas, and some people trade without momentum. And that's one of the most important things about posting in this room. So Rob, you're on the path. Um, I'm pretty good at identifying your thing. Good morning, Erla. And then once I do, we'll work together to beat it, to get past it. So good stuff. Good morning, welcome. Happy 26th day of August, ladies and gentlemen. As usual, we're going to go through news. So I'm going to drop in the link forexfactory.com/calendar. And every morning I'm looking for news, guys. Every morning I'm looking to see where a news release is to make sure that I'm not trading when it's active. All we had today was a little medium impact news at 8:30 a.m. and it really didn't do much. Um, Rob, price reaches an area. It's not just triggers, brother. You got to put it all together. If price reaches an area, man, it could stop the market. You look at your triggers to determine. And it just means you're going to have to pump the brakes a little bit. When we talk about termination conditions today, I want you to pay attention. I want you to stop trading and pay attention during termination conditions. Guys, no other news to worry about today, so we're going to move on. Everything that I talk about is going to come from the Nexgen website. Zero secrets, guys. I don't want to keep secrets from you. It's a circle of trust, right? Everything that I talk about, all the answers that you need come right from the trading guide. And I do this, and Nexgen does this because the goal is that you're successful, right? The goal is that you get excited, that you learn these rules, that you get forward. Hey, good morning, Josh. Nice to see you. And that you understand these advantages that we teach, guys. And I'm going to say it. I'll make the bold statement first thing on a Monday. This is the greatest software that you're ever going to have. The areas are unbelievable. The methodology is solid. But what we talk about in this room, guys, we only scratch the surface. There's so many ways to be successful with this software, but you've got to understand what the software is telling you. And that's why each and every day for the first hour, we talk about a high probability trade. We talk about a trade where each indicator on every chart agrees for the rules for the trade. When your triggers are the strongest, when no termination conditions exist, when there's no trouble spots between your entry and your target, guys, this is the best of the best. In this high probability trend trade that I teach, first hour, every day, this is not the only trade. Not by a long shot, but this is the first trade, guys, because it teaches you to read your indicators, and that's my goal. The whole goal of this classroom is to be able to read your indicators and recognize advantages and then turn those advantages into a trade. Chart reading, it's about 90% of your day. Chart reading is what tells you if you have advantages. Chart reading is what makes you want to be in a trade, guys. And really 90% of your day, if you spend 6 hours in front of the computer today, chances are you're going to spend about 36 minutes trading. But chart reading, once you get it, and once you understand the very basic concepts of the high probability trend trade, you're going to understand where the market is likely to continue. And this is actually your entry for the highest probability trend trade that we teach. And you're going to understand where the market is likely to go. And this is going to help you make great decisions on where you're taking targets. And then you're going to understand where the market is likely to stop. And these likely to stop areas are these key Fibonacci areas, guys, where the people that move the market are making decisions. And you will have a foolproof plan to not trade into these, to make sure that you're not trading directly into trouble. And all of that is going to come from three very basic rules, very simple rules on the high probability trend trade. Each rule will give you an advantage. Your first rule, strong triggers, is the advantage of momentum, guys, and that's going to provide you a market where the indicators are telling you that it's likely to continue in the direction of the trend. No termination conditions is going to have you not trading into lines on a large chart, which means that you will have room to your profit targets, which means that your path is going to be clear, and that's your second advantage. And I'm going to scream this one from the mountaintops, guys, and I hope that you believe me, but momentum and a clear path. Once you have these two, trading is almost easy. There's so many ways to get into the market. But once you can recognize momentum through strong triggers, once you can say to yourself, man, there is nothing between me and where I want to be, guys, all you have to do is find your entry area. Your first entry area is going to be the high probability trend trade entry area. Hey, good morning, Tom. But I'm going to say it one more time. Once you can identify these two, momentum and a clear path, you'll create your own plan, and you'll find a way to make the money that you need to make, and your entry area will probably change. But in the beginning, let's keep it super simple, guys. 3 rules, that's it. And we're going to do it on only 2 charts. And my laser printer is right over the first bar of the large chart, the slow chart, the broad stroke of the brush. This is a chart that's difficult to see change on. It's a slow moving chart. And you'll actually use the most current bar, the first bar in the lineup. And it will define the direction of the market. It'll define the momentum in the market, that first advantage through rule number 1. And it will define the areas and whether or not you have a clear path, rule number 2. When the rules are met on the large chart, and you have momentum and you have that clear path, you're going to turn your attention to a smaller, faster chart, guys. And this smaller chart kind of takes an x-ray of that one bar, because in each one of these bars on the large chart, there's about 20 to 30 bars on your smaller, faster chart. And this refinement process is going to allow you to pinpoint exactly where the market is most likely to continue. This becomes your entry initially for the highest probability trend trade, guys. It's going to allow you to reduce your risk. You will be able to increase your profit potential. And rule number 3 gives you that entry. And rule number 3 is what's going to change over time. But momentum and clear path should be a constant in your trading plan, whatever your plan may be. The 2 charts are being used because they really are a reflection of who's moving the market, guys. The large chart, your slow chart, it's a big crowd. It's the people, the men and women, that have it in them to create trends, to establish momentum. And these are the exact same people that are reacting to those key areas on your large chart. Your small chart is just a smaller crowd. They still have a lot of money. They're very powerful. And they can create little retracements, little pushbacks against everything that the large crowd wants. The cool thing is that we know through 27 years of study that the small crowd tends to fail 70 to 80% of the time, guys. So their failure point, the most likely point for them to just not be able to push anymore, that becomes your entry for the highest probability trend trade. And because they fail 70 to 80% of the time, it means that the potential is there for you to win 70 to 80% of the time through this high probability trend trade. And again, it's not your only trade, but let it be your first trade. Understand the advantages, and then you will find an entry. And the quickest way to get there, guys, it begins with posting your trades in the room. When you take a trade, drop it in the room. And what happens is you've just opened the door for a private consultation with me. It's a one-on-one, even though we're in a group of people. We're going to talk about the momentum on your chart, and we're going to talk about the clear path on your chart, and we're going to address your entry. And my goal isn't to shake a finger at you and say, man, that's horrible, what the hell were you thinking? My job is to say, hey, let's look at your chart read and let's see what you saw, right? So it's important that you talk about those three concepts: momentum, path, and entry. And the whole goal every time you post in the room will be to get you in a position to where your chart read is as accurate as it can be, that your entries have the least amount of risk and the most profit potential. And like I was saying earlier in the room, guys, once you post 5, 6, 7 charts in my room, annotate them, let me know what your chart reads are, I'm going to identify what your thing is. And everybody's got a thing. Everybody's got a rule that they break, an advantage that they forfeit. Some of them knowingly, some of them not knowingly. But one of the cool things about me teaching this room, guys, is I've broken every rule. I've made every mistake. I have broken everything that can be broken. And through an awful lot of study and feedback from the creator of the software, I've found a way to fix those problems. So I can address your problem and we can come up with a plan almost instantly to get you where you need to be. I just need to know what your thing is. The second is use the spreadsheet that I'm going to give you guys. And I give it in the room every day. Here it comes right now. The spreadsheet, guys, it's just a Microsoft Excel spreadsheet. Guys, even the futures market people, just totally brain farted. They say have a trade journal. And that's what this spreadsheet is, guys. Your first page is a trade journal. That's all it is. What did you do? What were your advantages? How did you do? And then most importantly, what was the feedback from class? And then there's the instructions on how to paste your picture into the spreadsheet. There's instructions on how to annotate a chart for the best results in the classroom, the best feedback. The second tab is the 3 rules in green for the high probability trend trade. And this is just designed to create recognition so that you understand exactly what it looks like to have those rules met. Rob, termination conditions would be a great section for you, right? Now that we've identified your thing. Favorite looks. Once you are a chart reader, once you recognize those first 2 advantages, you're going to be like, wait a minute, I keep seeing this and it keeps winning and it doesn't lose that often. Let me build my trading plan. Let me develop my management plan. Let me take pictures of patterns that I see happen and even those termination conditions. And guys, this is where you're creating your own plan based on your study and your class feedback. And then finally, there's the client trades. I have put in the entry sequences for the high probability trend trade, both short and long. There's about 300 pictures of clients using the software. They're not all high probability trend trades. They're not all going to fit that plan 100%. But what you'll find is that these are the Nexgen users more often than not taking advantage of momentum in that clear path. And maybe there's a different entry for them. Hey, good morning, Zoro. There's a section on the NASDAQ. Some of you are adrenaline junkies. Got some great information there on entries. The rules that I teach large chart are 100% across the board, whether it's NASDAQ or crude oil. But your entries on the NASDAQ are going to require a little bit more patience than they do on those smaller, mellower markets. There's a whole section dedicated to management with some ideas of when you can stay in, when you can get out, hold for bigger moves. Patterns that repeat themselves, termination conditions, guys. All of this has been dropped in the room. It's available to you. One of the easiest ways to get to where you want to be is to take pictures, and not just the pictures of your trades. Guys, if you scroll back historically and you take pictures of the patterns that you're looking to catch, it's almost as though it slows the market down. And I'm going to give you some stuff to help you do that. We're going to learn the rules for when it's okay to trade, guys. We're going to talk about the trigger lines. We're going to talk about the fibs, the areas, and we're just going to piece it together. Very simple. We're going to do it one rule at a time. We're going to talk about the looks for the rules, the advantages for the rules, and how to study the rules. You guys should simulate. Practice. Don't be afraid. I've got some new people in here. And I always hear, well, I don't really want to try it until I think I have it down. You're going to be learning for the rest of your life, guys. Get in there. Simulate. Practice taking pictures and practice annotating charts. and get that courage up to drop them in the room, because the people that post the most, these are the people that get to where they want to be the fastest. The idea and what we'll work on is that you're trading with advantages, that you're recognizing advantages and that you're embracing those advantages. Because what happens is when you trade just to get lucky, well, it was just simulator, so I put 100 lot and fought the trend, right? You're creating muscle memory, guys. We want you focused on the right trades. And then we're going to simplify today. We're going to talk about this high probability trend trade. I'm going to give you a rock solid plan that's designed to optimize your chances of success. It will be something that you can follow, that you can trade as a brand new user and still find a way to be successful with the software as you learn to read it. Your job is to know what looks you'll commit to. You've got to learn these looks so that they become easy. And the fastest way, guys, is look at what each rule looks like broken down. Don't worry about trying to learn it in the middle of a trade. Take a couple days to go back historically to take a look at these. Look at what the clients are doing, right? So when you talk about what a client is doing, you're going to begin to see the exact same look across the board. And it's going to commit, and the better you see it, the slower the market appears to move, which is actually a pretty cool thing. So we're going to kick it off, guys. Rule number one, strong triggers. Rule number one, it's number one for a reason, guys. Momentum is amazing. Large charts must have strong trigger lines, and when they do, we're going to have the advantage of momentum. So what does it look like? First, let's define trend. If the background is green, the large crowd is making the market go up, let's go up with them. That's the path of least resistance. If the background is red, the market's going down. Let's look for rules to be met for high probability trend trade short. If you're following rules, Rob, yeah. Don't trade into areas. They hold more often than they don't. That's why rule number 2 is in place. Guys, when your background is green, when the market is going up, the only way to have strong triggers is if the small triggers, which are these solid lines, it's 2 lines, they run parallel to one another, it's a fast moving indicator, and your large triggers, these dashed lines, again, they run parallel to one another, but both lines create the large, both lines create the small. When the small triggers get up and above the large triggers, when the background and your triggers are all green, the colors have to match, the space that's created between the small and the large, guys, this lets me know that the odds are favorable for the market to continue up. In a red background, the trend is down, the small triggers have to be red, the large triggers have to be red. And it's the space, that gap that's created between the small and large. This lets me know that the odds are favorable for the market to continue down. Odds favorable momentum. You're going to hear it all day long in this room, guys. Odds favorable momentum. Strong triggers gives you odds favorable momentum. OFM. They're synonymous. You're going to see it annotated on charts. OFM. You should annotate it on your charts, because what that does is it keeps you from having to type out so much. You're more likely to type. When I have strong triggers, the market is likely to push. These strong triggers have the potential to break key areas, and strong triggers will actually cover a lot of the mistakes that new users make. So strong triggers is rule number 1 for a reason, guys. It sets the tone. It creates the advantage. And let's see if we can find a strong trigger look. Strong triggers, market pushes up right to a line, and then it comes down. Strong triggers pushes it all the way down, has the potential to break these areas, but you'll notice that they keep stopping at lines. That's going to be rule number 2. But strength is separation. Scissors open is the easiest way to picture it. And when those small triggers return to the large triggers, when they work their way inside, we call this a weakening of the large triggers. And when you have those weakened large triggers, rather than odds favorable, we find ourselves in an anything can happen scenario. This is where key areas are more likely to hold. This is where you're more likely to get a retracement even from the middle of nowhere. And guys, anything can happen is exactly that. That advantage is gone away. So everyone in the room, especially my new users, give me a why. This is the easiest lesson you're going to get today. Strength is separation of the triggers, creates the advantage of momentum. Weakness is when the triggers come together. Is everybody good with that? Can you give me a why in the room if you're comfortable? And guys, remember, if you aren't comfortable with this concept and you don't give me a why in the room or an in the room, I can't help you. Awesome, thank you. Stoic Libra 94 Dunk, couple new faces. Great to have you guys in here. I'm gonna warn you guys, the first day or two, it's like drinking from a fire hose. You're gonna feel like there's a ton of information coming after you. By the third day, maybe the fourth day, it all clicks and you're like, holy smokes, this is not nearly as difficult as it seemed on day one. Guys, once we have strong triggers, we're going to make sure that the path is clear. We're going to make sure that there are no termination conditions, guys. A termination condition is nothing more than a line on the large chart. These are the lines. And any one of these lines can stop the market. Any one of these lines can create an untradeable bounce. Any one of these lines can set off a fight between the buyers and sellers. And the easiest way to think about it is you don't want to be trading into the line. You don't want to be trading into the decision-making process. So these are the areas, guys. One is not more important than the other, but if it's a horizontal line on your large chart, it has the potential to stop the market. That's the easiest way. This is nothing more than a roadmap. This has nothing to do with rules or management or anything. This is just the lines and what they're called. So if you hear me in class say a divergence high, you know that I mean the magenta line coming off of a pivot. And if you hear me say yellow 1-to-1, you know exactly what I'm talking about. But they can all stop the market. And it's pretty easy. And Rob, this is for you, brother. And let me go back to this picture real quick. Large crowd. Large crowd defines the areas that are important. Large crowd reacts. And it's crazy how accurate these fibs can be, guys. And the fibs, when they're termination conditions, stop the market more often than they do not. And that's why rule number 2 revolves around not trading into these areas. So price reaches the area. This sets off the decision-making process. My dynamic Renko bars are trending up. Everything is good. When they reach an area, when they hit that area, guys, we don't know what's going to happen. We don't know if the buyers are going to jump ship. We're not sure if there's a whole crowd of sellers waiting to take over. We don't know if there's going to be a fight. But if price reaches a line and the triggers remain below resistance, or price reaches support, a line, and the triggers remain above, no more trades into that area. This is an area that may stop the market. And that's it. So if rule number 2 is your thing, every time you're getting ready to take a trade, you should ask yourself, did price reach an area? Where are my triggers? In doing so, watch this. Price reaches an area. My triggers remain below. No more long trades. And the loser is avoided. I'll just use the same one. Price comes all the way down to support. The triggers can't break. Another time. All the way up to resistance. Triggers don't break. So guys, what you're seeing over and over is the power of Fibonacci. The idea that these lines, and one's not more important than the other, get over here. Just trying to drag it around. There it is again, right at a divergence high. There's support holding. And guys, what you'll see is even with odds favorable momentum, when price reaches an area to the tick and the triggers remain above, it's okay to do nothing, guys. It's okay to sit on your hands. It's okay to wait and see what the reaction is going to be. Is everybody good with that? Because I think defining the termination condition has got to be the first part, guys. And it's not a difficult recipe. The only thing that really creates challenges with termination conditions is our own desire to trade into them, hoping that they break. But they became a rule, guys. Every rule that is in the high probability trend trade, every rule that Nexgen teaches is based off of probably a minimum of 1,000 pictures and a pattern that has been proven to win more than it loses, or a pattern that's been proven to lose more than it wins. So trading into areas, 60% of the time, you're going to lose every time. Stoic, easiest lesson ever. It is a byproduct of the calculation to create the divergence. And it doesn't matter if it's a 1 or a 999. It is only a byproduct, and there is zero significance. So divergence, let me back it up one. Divergence is just, it's a clever way of saying that there was a loss of momentum at this pivot. And if momentum doesn't follow price, right about the third bar, the calculation is done. And what's important is that you see this magenta line, and it just lets you know, hey, guess what? There was a loss of momentum. You'll see it at lows as well. Divergence lows, it just means that there was a loss of momentum at the pivot. On its own, it's just a loss of momentum. We don't even worry about it. But check this out. Oh, where's my large chart? If price comes back to that line, this is one of the lines that can stop the market. And you see that it does it right here as well. So on its own, just a loss of momentum. But when price reaches that line and the triggers remain below, we won't trade into that one. These negative numbers are nothing more than a byproduct of calculations. Does that help? Awesome. You're welcome. And man, just keep the questions coming. Guys, one of the best things that you can do in this classroom is just ask. I appreciate every question, and it makes it easier and easier. So this is when it's time to sit on your hands, guys. This is when the path isn't clear. Good morning, PFI. Sorry. This is when rule number 2 isn't met. So when is a path clear? Guys, a path is clear. And let me back up just a half a step. Every time you reach a line, chances are it's going to be a termination condition, even for a minute. You're okay, Rob. Even for a second, price reaches, triggers remain above. You just got to say, whoa, pump the brakes. Let's wait a second. Let's see what happens. When your small triggers, both lines, and the large triggers, both lines, get below support, support is broken. The path is clear until you reach the next line. And what you'll notice is that support begins to behave as resistance, guys. And very often the market will pull right back to that key area and continue down. When your small triggers and your large triggers get above resistance, resistance behaves as support. Your path is clear, and with this momentum, you'll be looking for that rule number 3 entry all the way until you hit the next line. Rob, is your picture a question about terminations? Cool, then let's open it up and take a look. Perfect. Directly into a termination condition, Rob. Perfect. Price reaches the line. Triggers remain below. And now it may break, right? But in this moment, Rob, your highest chance of success is to sit on your hands. Price reach resistance. Triggers are below, right? Price reach support. Triggers remain above. It's absolutely perfect, Rob. Yeah, fib, made it. Every line that price reaches. If the triggers are below resistance, above support, below divergence high, right? That's your recipe. That's how you're going to define. And what you'll find, Rob, is that your triggers may get above resistance, but if they reach the next line, the process starts over. And this is one of the things that frustrates new users. This is one of the things that frustrates you guys that like to be moving rather than sitting. is there will be times on your large chart where there's just area after area. There's been so many fluctuations in the market that you've got a pretty good run of fibs. And when you reach this one, you have to say, wait a minute. Rob, I think what you're doing, you're not finding more room to profit though. What you're doing is you're decreasing your distance to the profit because you're trading directly into an area that may create a bounce. That doesn't create more room. And I see exactly what you're saying. Trading into this line on a pullback doesn't create more room. What it does is it creates a trade into an area that may stop the market. So just because you have a pullback, and let me show you exactly what I mean. Just because you have a pullback to an area inside of triggers, right? Small chart is only an entry chart when the rules are met here. How come? Because this right here says don't even look for it. Don't do it, Rob. And that's exactly where the market bounced up, right? Exactly where the market bounced up, and you probably took your loser on that one. That's a huge stop, by the way, as well. So it's almost too easy because that's it. Hit a line, where are my triggers? Guys, it'll keep you out of an enormous amount of losers. I have a clear path, let's look for an entry. And it's the time in between, guys, when there's stacked areas. It's the time in between where your rules force you to do nothing. Guys, this is the difference between successful traders and the traders that really find challenges. The traders that seem to spin their wheels. The people that teach themselves to do nothing when there's nothing to do. The people that can sit on their hands when the advantages aren't present. Well then, Rob, respectfully, shame on you if you're not looking at those lines. Why do you have the software? These lines are gold. Guys, Fibonacci gives you the ability to see where the driving forces of the market are likely to make decisions. And very often, rule number 2 will keep you out of consolidation. It'll keep you out of chop. It'll keep you out of unnecessary losers, guys. 90% of your day is waiting for that clear path. 90% of your day is sitting on your hands and doing nothing. But what you will find is that when you master the idea that you shouldn't always be in a trade, when you understand that the futures markets trade billions of dollars every day, and you really only have to catch about 400 of it a day to put yourself in a 6-figure income, guys, patience is where it's at. Patience is so much of trading. So when the large chart has momentum, guys, when the large chart has a clear path, you're going to turn your attention to a smaller, faster chart. You're going to look for an entry. There is one time on a smaller, faster chart where the path is not clear. And this is the only time that the small chart will ever define a termination condition. And this is 3 divergences, 3 of those blue lines from a low, magenta lines from a high. 3 divergences in the same price range may terminate the trend. It's important that you notice Nexgen uses the word may, and it might, and it has the potential, and it could. Because the reality is we never know what the market's going to do, but the market has a memory, and the market creates patterns, guys. And this is one of the patterns that loses more than it wins, which is why we don't trade into it. So if you're looking for your entry on the small chart and you see 3 divergences from a low or 3 divergences from a high, it's okay to sit on your hands. This is just as powerful as hitting one of those lines with the triggers remaining above or below. So guys, these are our first 2 rules. It took us 23 minutes to get through it. So Stoic, how we doing? Miss Andrea, nice to see you back in the room. Josh, you too. We doing okay so far? Momentum. That first rule being met, making sure you have a market that's likely to push. And then once you have it, don't trade into a line. That's the easiest way to say it. Don't trade into a line. Get to the other side of the line. And then once you have it, guys, we're going to define our entry. We're going to pinpoint exactly where the market is most likely to continue. That's okay. Thank you for that. I think it's better to be a slow learner, to be honest with you. I think most people come into this room and they want to know absolutely every concept, and they want to know it yesterday, and they're impatient and they rush to the trades rather than the advantages. So embrace it. Embrace it. Take all the time you need. I'm not going anywhere. You're stuck with me. You practice your patience via replay at one-time speed for 3 hours of practice? Man, I'm not even that patient. Josh, that's you. You want to know it all yesterday? I'm the same way, man. I really am. If I know there's answers out there and I don't know what they are, it drives me nuts. I have to find them. And so I know completely, guys, when I tell you to pace yourself, to keep it simple, I understand the fight that creates in so many of us. But guys, we have momentum and we have a clear path. And I want to go back to this picture, the large crowd. And we can even see it right now, right? The large crowd said that the market is going up. The background is green. The large crowd said that we have odds favorable momentum because of the separation between the small and the large. And the large crowd said that we hadn't reached an area, guys. And when the large crowd says, look for an entry, we're going to let the small crowd do their thing. We're going to let them fight. Their fight creates a retracement or a pullback, if you want to call it that. And this is a little fluctuation in price that's counter to everything that the large chart says. We're going to pinpoint where they're going to fail, guys. And we're going to do it with such accuracy that we're going to wait for them to get to us with a limit order. And that limit order is going to be at an area. Fibs, mid-bands, or yellow 1-to-1s. These are the areas that create a bounce. And here's the most important thing that you can do as a brand new user is allow those areas to be inside of what we call favorable large triggers. And the whole idea behind that is that price returns to the large triggers, and it doesn't matter what kind of chart it is. Price returns to the large triggers. It corrects. It's a moving average. So there's large triggers on your large chart. Let's go see if we can find a real world example. Price pulls back to the large triggers. It pulls back to the large triggers. We see it here. It pulls back, it pulls back, it pulls back over and over again. It's almost not guaranteed, but that is the most likely scenario on the large chart. It does the same thing on the small chart. So what we've done is we've taken the large chart large triggers and we've called them the synthetic triggers on your entry chart. They look like they have little steps, but they're just a large trigger. And then the small chart large trigger, the smooth ones, these are the ones you'll use to gauge that momentum. Guys, we put them on the same chart. So now we have two charts, two correction points, and when they overlap, when those large and synthetic overlap, and I want you to picture two snakes riding piggyback, guys. This is what we call favorable large triggers because it takes one correction point from each chart and it puts them in the exact same place. And then when you put areas inside of those favorable large triggers, you give the market something to bounce off of. This is how we pinpoint where the small crowd is most likely to fail, guys. This is what's going to reduce your risk and maximize your profit potential. So for a brand new user, insist on those favorable large triggers. It makes life easy. It really does reduce risk and it takes a lot of the indecision out. When your large triggers and your synthetic triggers begin to split or break away from one another, guys, it's going to decrease the accuracy. It will increase your risk, and it's harder to pinpoint an entry when they're not one on top of the other. So when you're speaking out loud and you're saying, what does Rule 3 says? Rule 3 says that I'm going to use a limit order to buy or sell a pullback at an area inside of favorable large triggers, and I'm committed to that favorable look, at least for the first 30 days, until I begin to recognize patterns where there may be other advantages. So how do we pinpoint it, guys? It's a pretty simple process. The first thing is that the rules are met on the large chart, which means that with this green background, my large chart says up. My large chart has odds favorable momentum, and my large chart has absolutely nothing in the way. And guys, that market's going to be railing to the upside, and your fear of missing out is going to kick in. You're going to be like, oh my gosh, they're going up. Everybody's making money but me. And then this crazy thing happens. The reversal bar prints on your small chart, your first red bar after all these green bars. This signals the beginning of the fight with the small crowd. This is the beginning of your pullback, your retracement, whatever you want to call it. And the reversal bar is not your entry. The reversal bar signals that it's time to look for your favorable large triggers. Large, synthetic, they should be overlapping one on top of the other, guys. And the trigger lines are not your entry. The trigger lines are where we expect price to return, to correct, if you will. Once I've identified my trigger lines, I'm going to look for the areas within, and I'm going to create a window of opportunity. I don't know how that name came into be. I think someone was a Ric Flair fan, and they called it the Woo. And so from the highest point of support, in this case it's a mid-band, to the lowest point of support happens to be these yellow 1-to-1s inside a favorable large trigger. So for all of you folks that are new, for my Joshes, my Stoics, my Andreas, all you guys that are new, I want you to really latch onto that word, inside favorable large triggers. This blue box represents the point where the market is most likely to bounce, where the trend is most likely to continue, where the small crowd is most likely to fail. Because of the momentum on the large chart, because of the clear path on the large chart, your limit order goes a tick or two above that highest point of support, guys. And this is your entry for the highest probability trend trade that you can take. Any line beyond the triggers, beyond the correction point, any line beyond those trigger lines is not a part of the window. We don't want to see the market come down here, guys. If it does, it means we're looking at one of those 20 to 30% as opposed to the 70 to 80% that launch with the trend. In a downtrend, everything is down. The market's screaming to the downside. We have odds favorable momentum. There's nothing in the way. And the reversal bar prints. You guys sit on your hands and you wait for the reversal bar. And once it prints, it's not your entry. You're going to identify your favorable large triggers, and then you're going to look for the lines within, the areas within. And in this case, there is one line. There's a mid-band inside of favorable large triggers. That one line represents the point where the market is most likely to continue, where it's most likely to bounce, where the small crowd is most likely to fail. Your limit order goes just below that area inside of favorable large triggers, and that becomes your entry for the highest probability trend trade. And then once again, any area, any line beyond the top of those triggers, this is not where we want to be. This is not our entry. This is not where we want the market to go. Guys, this area is where the market shouldn't go. And once you can define where the market should continue, you're going to use that where it shouldn't go spot for your first stop. Your initial stop placement, guys, will be typically 4 to 5 ticks above the trigger lines, beyond the correction point. 4 to 5 ticks, because once it gets beyond there, I don't know what that means, Rob. So a stop anywhere? How about, call me crazy, I'm gonna make this really, how about if instead of a stop anywhere, we actually focused on the words, generally 4 to 5 ticks above all the trigger lines. Guys, once you learn how to say your rule, it takes a lot of the guesswork out. So above the lines is a pretty broad scope, right, Rob? How about 4 to 5 ticks above the trigger lines? Reduces risk, right? You know where the market shouldn't go. It shouldn't go beyond those trigger lines. So 4 to 5 ticks, I'm done. That's it. I'm out. And you will take losers. Stoic, you're going to take losers. Andrea, they're going to stop you out. Josh, they can't wait to stop you out. You and Dunk. But it's okay. It's a normal part of a positive equity curve, guys. And what we're doing in the beginning is we're making sure that if we lose a trade, we lose the correct trade. We lose the trade that had momentum, that had a clear path, that had the entry area. Every now and then, these guys eat their Wheaties and they're going to get you. But more often than not, you're going to get a reversal bar back in the direction of your trade. And you'll be able to actually reduce risk above that reversal bar, below that reversal bar. And it's not uncommon to see you Nexgen users taking the perfect entry and having maybe 3 to 4 ticks of risk on a trade once it starts to move in the direction of the trade. So my goal for you guys, hey, good morning, Kenan, is that you go back and study this historically. Look at the pictures in the spreadsheet, but I think one of the most important things that you can do, guys, is you can scroll back on a large chart. And if you have momentum in a clear path, and it hasn't happened a lot today, so we'll just pretend like it did, and you see one of these tails. Guys, these tails are the pullbacks on the small chart. These tails are that retracement that we're looking for. So if the rules are met, and they're not, I totally get that's a termination condition. If the rules are met, you can take those tails on the large chart. You don't even have to take a trade. Scroll back. Did it pull back to an area inside of favorable large triggers? Well, it didn't. That termination condition created challenges, and you can just scroll back and look for the next one. Right? There's a look. Right back to the mid-band, right at the triggers. So you can begin to commit this look to memory by scrolling back on your large chart, by circling these tails, by saying, look at all that momentum. And look how it pulled right back to resistance, right inside the triggers. Look how it didn't go beyond those trigger lines. Look how there was the opportunity to make money. And then 3 divergences, sure enough, stop the party. So the easiest way to get to where you want to be is to study these historically a little bit. Go back and circle those tails. Look at the correlation between the two. Not every tail is going to be a high probability trend trade, but what you can do is you'll begin to recognize this pattern, this pulling back to areas inside of triggers, and you'll see just how often price corrects to the triggers and how often it doesn't get beyond the triggers and how often it bounces inside of the triggers, guys. So I always encourage you guys, take as many pictures as you can. Go back and study it. Price reached a divergence high. The triggers remain below. Look at the reaction. Price reached a divergence low. Triggers remained above. Holy crap. Look at the reaction. And it just blew right through that mid-band in a trigger. Kind of crazy, right? You guys knew where these lines were. And you had a rule that said don't trade into it. And guys, that's my first hour every hour where we talk about this high probability trend trade. And then I remind you guys that the easiest way to get to where you want to be is not taking a trade, but rather taking pictures, guys. Committing these patterns and these looks to memory. So this is the chart reading 101. I'm going to give you all this stuff that I'm sharing with you right now. And this says if you want to get to where you want to be the fastest, right? So you guys that have to know it all yesterday, do this drill. You'll know it a lot quicker than the people that do it passively. Take 25 pictures of strong triggers and of weak triggers. Know the difference between the two. Take 25 pictures of a clear path. Take 25 pictures of a termination condition and know the difference between the two. And then take those entries, what it looks like. And guys, the spreadsheet, I've done a lot of work for you. You are 47 pictures deep on strong triggers. You are 22 pictures deep on weak triggers. You've got a clear path. You've got terminations. You've got entries. And all you have to do is be able to piece these together to create the trade. And it takes a little bit of study. It really does. But if I click on strong down, it's not just the picture. It's the annotation as well. Talk about the whys. Smalls below the large, wide in the direction of the trend. The space between means strong triggers. Odds favorable momentum, rule 1 met. Does anyone in this room believe that if they took and annotated 25 pictures of exactly what it means to have strong triggers, that they're going to make the mistake and accidentally go, oh man, where are my weak triggers? I really thought that those smalls inside of the large meant strength. Strength, weakness. You've got to know the difference between the two, guys. So the chart reading 101 is designed to get you there. Talk about the whys. What are the advantages? And I don't expect you to know these looks on day one, which is why I gave you this, the high probability trend trade checklist, with pictures of what it means to have momentum and what it means to not have momentum, so that you can go through and make sure that you're taking the correct pictures. What it means to have a termination, what it means to have a clear path. And then guys, once you can define these two, here's kind of a cool thing, and this is going to be your second trade, is you'll begin to recognize when areas have the potential to break. And guys, when your small triggers smash through an area, right? And the large triggers are lagging because they're a slower indicator, guys, with odds favorable momentum, with the smalls smashing through the area, this area has the potential to break. And I'm going to give you a rock solid plan to take advantage of when the potential to break is there. And it's not a high probability trend trade because you don't have a clear path. But guys, this is another way you're going to be able to capitalize. So you've got to know the difference between termination and clear path so that you can piece together the idea of when it has the potential to break. And then finally, windows of opportunity, how to enter the trade, where your order goes, what's not important, what you're waiting for, 100% guys, to make sure that you are solid and good. And then finally, the KISS plan, the Keep It Simple Sunshine plan. And guys, this is a stepping stone in your learning journey. Once again, this is not the only trade. This is your first trade. This is your foundation trade. This is a trade that typically wins 70 to 80% of the time. This is a trade that creates confidence through the memory of success. And guys, this is the trade that's going to teach you to read your indicators, because once you can pick out your entries here, guys, the sky is the limit. So it's designed to optimize your chances of success with the high probability trend trade as a new user. And then through simulation, study, class feedback, and continuous practice, you're going to be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators, which is a fancy way of saying, guys, when you're a chart reader, you're going to see things and you're going to develop your plan. And the cool thing is you're going to develop it in this room, and you're going to ask a million questions and post a million pictures, and we're going to help to work on your plan together. But in the beginning, keep it simple. Your simple plan for consistency. Don't fight the large chart. I can't even stress that enough, guys. In 27 years of teaching people to day trade, these are the two most common problems that new users have, because both of these require a level of patience. The first thing, how to commit financial suicide, guys. One easy step. My brother wrote this book. It's only 1 page long. The rest are filler. Chapter 1, warning signs your friends are in trouble, guys. They're trading against strong triggers. They're fighting the momentum created by the people in charge. More often than not, this is going to result in a loss. Chapter 2, warning signs your friends are not paying attention. They trade in determination conditions. Seek help immediately. Guys, you can identify the momentum of the market. You're going to know exactly where these problem areas are. If you can commit to this right here, don't fight the large chart, you're already 60-70% ahead of the curve from the average trader. And then you're just going to define your entry. 20 days, that's all I ask. 20 days. That's not a long time, guys. To define your entry, to get good at picking out where the market is most likely to continue. Your entry for the high probability trend trade is very mechanical, guys. It is very methodical. It removes emotion, and it's nothing more than if then. If my rules are met, then I will enter the market. If my rules are not met, I will not. And guys, great entries create manageable trades. So once you're in at the point where the market is most likely to continue, you're going to have to manage it. And guys, your management is designed 100% around your ability to get in where the market is most likely to continue. So practice it, study it, post it in the room, ask a bazillion questions until you're comfortable with that entry. And then your management for the brand new user should be just as mechanical as your entry. It should be just as methodical, because rules eliminate emotion eventually when you trust them. So your management plan, goals met feels good. I love it, Andy. Your management plan is very if-then, very basic, very mechanical, very quick in the beginning. And you will create a management plan outside of this one, and it probably won't take you long to do it. But to develop a management plan, you're going to need to be able to read your indicators. So your management is designed around you getting in where the market is most likely to continue. You putting your stop where the market shouldn't go, 4 to 5 ticks beyond those triggers. And then if you're not stopped out, you're probably going to get a reversal bar in the direction of your trade. And this is your first stop movement. Your first stop movement will put that stop 2 ticks above the reversal bar for a short trade, 2 ticks below the reversal bar for a long trade. And at this point in the trade, there is absolutely nothing for you to do. You're either going to get stopped out, and guys, it's okay. I think one of the best things about simulators, it teaches you to lose. It teaches you to be okay with losers, but it also gets you focused on making sure that your losers are the correct losers, that you make them come get you and you don't offer yourself over to them. From this reversal bar, you're either stopped out or your first target is hit, guys. And your first target, KISS plan users, is $100 away from your entry. That's it. It's a super quick target. On crude oil, there's a lot of times where you're going to hit that target at the exact same time you get your first reversal bar. And once you hit it, that money's in your account, simulated or otherwise. That's your money. They won't take it back from you. So your next stop movement is to go to break even. You just got paid. Your palms kind of dried up a little bit and the butterflies settle down. And now you have absolutely no risk on the trade, guys. None. Zilch. It's your break even. That's the worst case scenario. And this is to remind you that the only reason that you're in this trade is because the large chart told you that the market is dropping like a ton of bricks and there's nothing in the way to stop it. So you're just saying, I'm going to learn to trust the large chart. I'm going to learn to believe in that momentum. I'm going to learn to accept that this is a market likely to continue down. And you're either going to get stopped out, break even, or it's going to hit your second target. Once again, guys, quick targets for brand new users. Very fast, easy to hit when the rules are met targets. Your second target is only $200 away from the entry, which means that with the odds favorable momentum, with the clear path, with the great entry, with the very mechanical management, this becomes a $300 trade. And guys, it may drop another 20 points after this, but you don't care in the beginning because the whole goal is to get paid. The whole goal of trading is to win more than you lose, to have a statistical advantage every time you enter. And guys, it doesn't take a home run to be a successful trader. And I'm going to give you this as well. Daily goal times 252 trading days a year. That $300, if that's the best you do every day, that's a $75,000 year in your trading account, guys. That's not so bad for one trade, right? That one trade is certainly not all of the opportunity in the market. 500 is pretty easy to hit. That's 126. 900, 1,000. It just keeps going up, guys. The better you get at it, the more likely you are to make more money. But you've got to learn the basics first, guys. You've got to learn the process that yields the results. And when you're trading, it's imperative, I love that word, that you understand why you will enter a trade, right? Why will I enter a trade? Why is there a comma there? What does that mean? That means that you need to know your rules. You need to understand your rules. You got to know what they look like. You got to know what advantages they create, guys. You got to know why you're going to enter the market. And then there's the hard one, is why will you exit? Why will you exit that trade? What's going to get you out of that perfect entry? In the very beginning, it's going to be the KISS plan rules. But as you grow, your management will grow with you. But for brand new users, commit to having the rules met. This is the hardest thing to do because we love to say, I think it's going to go up. It should go up. Some of my favorite annotations are when people go, I don't have a clear path, but. And we call that showing your butt. And when you show your butt, you're more likely to lose. You know you're breaking rules, guys. Commit to having the rules met because your rules are patterns that have been proven to win more than they lose. Nexgen has gone to great lengths to study this, to back test it, to trade it live, to make sure that the high probability trend trade is your best chance of success. And the more consistent in action that you become, the more consistent in profits. Your process yields the results, guys. So rules help alleviate emotion. They get rid of that fear, that greed, that anxiety, that adrenaline. And it just becomes a matter of it's either met or not. And my stops are where my stops are. They can either get me or they don't. And it sounds like, oh, that would never happen. There's too much going on. But guys, it really does become that way. And then your KISS plan will take you to your second trade, that potential to break trade, guys. And there's the rules for it. And there's the management. The management is different. So it's important that you learn the easy stuff first, and then you'll go to the next trade. Get really good at one thing before you go to the next. So we made it through our first hour. Good job, everybody. And we just had momentum and the potential to break that divergence low, and it pulled right back to the synthetic triggers. Look at how price returns to large triggers. Isn't that crazy? Over and over and over again, guys. And this is the S&P, and they're trying to work through right now. And there's crude oil, and everything says up. And the large triggers made it right through resistance, and it pulled right back to support inside of those favorable large triggers. In the reversal bar, if you were in at 47, you already made $100 in your break even. Pretty cool, right? Hopefully somebody shows me this trade. Guys, I'm going to take 5 minutes. I'm going to encourage you to take 5 minutes. Go stretch your legs. You don't have to be in front of the computer nonstop, guys. The market will be here when you get back. Go scratch the dog behind the ear. When I come back, we're going to start clicking on the pictures that you guys posted. And I'm not going to click on them and beat you up about whether or not you followed rules, and shame on you. Some of you I will, because you should know better by now. But what we're going to do is we're going to talk about the momentum on the chart. We're going to talk about the path, and we're going to talk about your entry. And if there's a way to do it better, whether it's read it better, enter better, manage better, we're going to talk about it. I'm going to give you that feedback. So your commitment to me has to be that you talk about those three things: momentum, path, and entry every time. And if you tell me the path was clear and it's not, well, then you open the door for a lesson on clear path. Or you tell me the momentum was weak but it was strong, then it opens the door for a lesson to get you that clarity. And it's these pictures. I'm not worried about your P&L, guys. Don't ever say, yeah, I broke the rules but I won, because all you're doing is you're setting yourself up for long-term failure. So that's what we're going to do when I get back. I'll leave you with this one as it wins. And I'll see you in about 5 minutes, guys. it. Second hour, I'm going to start clicking on pictures. We're going to start looking at charts. I'm going to scroll up to the top of the room. Paul did a little work this weekend. So Paul, one of the things, if you're going to post your 8 range, tell me what's going on the 8 range that's getting you in. It'll help me a little bit. Because here I see a long directly into resistance with weak triggers. Do you see it? And guys, if you let your 8 range chart talk you into trades where the large chart doesn't agree, you're getting lucky at this point. But once the area breaks, the long is pretty easy. But there's never any strength. And you're way outside and there's no strength, and I'm not sure what it is about the 8 range chart that's talking you into this trade. And there's the same one. 3 divergences on the 5-1. First 2 divergences are short, do not extend with the market. Only the third diversion extends with the market. I don't know what that means. Does this mean the 3 divergence rule is not valid and must add 2 more to be effective rule? So I only see one effective divergence that has no other meaning than a loss of momentum, so long entries are valid. There's one divergence. Small and large get above it, the divergence is broken. There's your first divergence then. Yeah, it's one divergence, but you don't have strength. You don't have areas inside of favorable large triggers. Here you do. So Paul, you had one entry, made sense. But without strength, with weak triggers, with no areas inside, it becomes a little problematic. So a little more 2 years than the average bears, which is totally cool. All right, Rob, we're going to revisit having talked about termination conditions. And guys, this is another reason that I think annotation is so important. Odds favorable momentum? Absolutely. Can you guys hear me? So Rob, do you see how the path wasn't clear? Thanks, Morgan. Do you see how price reached the area and the trigger lines didn't break? And therefore, rule number 2 isn't met, and it takes away that advantage of a clear path. Does everybody see it? And guys, it's okay. Look how pretty the small chart is. It looks like a short, doesn't it? But the large chart said, hey, let's not do it. Let's pump the brakes. It's going to be a long day if you guys are this quiet. We covered that one. Gino. Good morning, Gino. Strong bottom, which means termination that reverses the market. Odds favorable momentum. And Gino, you're trading directly into a termination condition, right? Right into that pink line. And you said, you know what? I'm going to take it. Every indicator is pointing up. And I'm not sure where your entry was. Thought it would go and it did. Divergence scared you. You got flat, so you got in and got back out. You'll learn to trust. It's not a bad looking trade, Gino. Andy Man. Good momentum from a strong bottom. It was 50-50, pulled back. Not a gap theory look, Andy. Do you see how the large triggers weren't a full bar away? Nothing really gap theory about that. But they are still up. and every trigger is above support, and the mid-band created a great place for a bounce, you get in on the correct side, took 2 trades and 2 bits, you get out at trouble, and then you get back in and you get out at trouble. It's awesome trading, Andy, but it's not the gap theory. Not on this one. The large triggers are too close, but with everything still up, great job taking advantage. And then Gino. Odds favorable, not quite a clear path. You get in on the pullback to the mid-band. Andy, though means that, I mean, you can say though all you want, but it's not even close. It's not. It's like half a bar. So if you start creating all your own versions, right, you're going to hurt yourself. It's okay. Termination reverses the market, odds favorable. And then, hold on, is this Gino? Hey Gino, very much a strong top. Termination condition reverses the market. No triggers got through. That's like the best look ever. That is a very much strong top. Odds favorable, and you're trading into the divergence low, but you get in at the mid-band inside of triggers. You know where the stop has to go, and then you jump ship when it finally starts going. Two divergence. So it is a line, isn't it? It's a big pink line. And price reached it, and the triggers remain below. And guys, this is why I encourage you to really focus. Any one of these, Gino, any one of these lines can be a termination condition. No, I mean it is. But look at this. Price comes up, and it reaches the line, and the triggers are below. That's total termination condition. Now, that's two divergences at the same spot. It never reached the pink line. But this one actually made it. And guys, why this is so powerful, and I'm going to turn this into a lesson that you may or may not need, Gino, but it's for everybody. So right here, the sellers stole the momentum from the buyers. That's why we get that pink line. And they said, buyers, go to hell. We're going down. And then the buyers hit the mid-band, and they're like, but we really wanted to go up. And when they go up, they hit that pink line. And this is where the seller's like, dude, we told you. No. And look how it reverses the market and creates that momentum. Gino, this is a beautiful termination that reverses the market. It's a strong top. These divergence lines are very much lines in the sand where momentum was stolen. And when they try to come back to it, that's when it becomes problematic, which is why you're trading into a termination condition right here. Does that make sense? And then, Gino, when you finally get to the other side of the triggers and everything is going down, like you sat through the scary part, and then you finally got to the good part and you jumped ship. It's a nice trade and a good lesson. Any one of those lines that can stop the market can behave as a termination. And if that termination reverses the market, good stuff. Kenny. Look at this, guys. Pivot stop out, good bottom, termination that reverses the market, creates odds favorable momentum. Look at that look. Odds favorable, clear path. You get in a couple ticks above the mid-band. It doesn't get below the triggers, and you take it all the way up and get out at resistance. Kenny, that's awesome. That's everything we teach, isn't it? Newer users, can you see how the circle that he put on his entry, it lines up? The bottom of that pullback is the bottom of the tail. Kenny, this is just, I mean, that's everything. That's the best of the best. That's the easiest trade that you'll ever take. And one of the things, and guys, I don't ever tell you how to trade, but one of the cool things about what we do is that we know where the market is most likely to go to, right? Where it's likely to continue to with that level of momentum. And it's okay to get paid at a line. It's okay to get paid at a line. It's all right to just say, hey, you know what? There's a line. Let me get paid. You took your girls to school, came to the computer, and that look was staring at you 20 seconds, and I love that. That's how it was for me when I woke up this morning. I grabbed a crude oil trade. I literally opened my eyes or the computer, and I was just like, whoa, I got to be in that. And that happens sometimes. Guys, this is the one. If you're inclined to fill out your favorite looks section, that's it. Guys, that's the best of the best. Steal it. It's okay to steal it. Drop it in there. Call it the perfect long. Study this look. This is the look. I'm stealing it from you, Kenny. I want to do what you do when I grow up. All right, Gino. Into a termination condition again. Did this one on Sim because you didn't trust it. Price reached termination. Divergence potential was showing. Strong top. I've learned, and odds favorable. Trade went the right way. Targets hit. The fact that you didn't take this is a real bummer. Is it? Is the fact that you followed your rules a bummer, Gino? I think historically we've shown that when you break them, you lose less than you win. There's nothing worse than post-broken rule regret. Because you'll break them next time, and that termination condition will whip your butt. Odds favorable. Not even a 50-50, Joel. You are directly into a termination condition. 100% no triggers through. Doesn't matter if I would or not, Gino. I could come home from the longest day ever, exhausted and half-cocked from the bar, and still not kiss your wife because it's not mine. My rules say don't trade into termination conditions. That's it. That's what my rules say. My rules insist on a clear path. And if I don't have one, I don't care. I don't care what the market does. Because the one thing that I'm sure of, Gino, the one thing that I'm absolutely positive of is that these lines stop the market more often than they don't when the trigger lines haven't broken. And I try not to trade based on luck. So Joel, are you with me here? I'm going to go like this on the bar that you entered on. Yes, it is greater than 50% losses. How's that? Gino, it's amazing that you recognize that it didn't fit your rules, but the fact that you took it on Sim, what you told yourself, and people think I'm such a pain in the ass when I do this. Gino, what you told yourself by taking it anyway, what you told yourself by watching it win, is that next time you see a termination condition, your brain's going to go, Gino, F it, man. Remember what happened when we broke our rules last time? Let's do that again. That felt good, Gino. We won. Even though, look at this. This termination condition stopped it, and this termination condition stopped it. And that's the one, right? It broke this time, so it must be good. I'm telling you, your brain's a butthead and it'll do that. All right, Joel, did you really have a 50-50 on that one? No. Okay. I just want to make sure you get it. And you know what? If you took it here and said 50-50, awesome. And Joel, are they really favorable large triggers if your synthetics are all the way down at the reversal bar marker and flat? Of course not. They're not overlapping. They're not strong. They're not wide. And this is why, and Joel, it's a good looking trade. It's a low probability trade, and you took it from an area. But these are the ones, guys, where if you're not consistent every day, you have to be careful what you type on your charts. And we start typing out of habit. If I type clear path, then it must be true. If I type area inside of favorable large triggers, then it must be true. And then, Joel, you've been with me long enough. When there's a bad bottom and you hit the mid band and resistance and the large triggers aren't following, that's more likely to go down than up, isn't it? That mid band's more likely to hold with this look. Yeah. But because you made money on it, your brain is going to convince you that that's the right trade. And guys, this is one of the biggest challenges that I see with new users, is that we take trades where the rules aren't met. And because of that, when they win, we feel like that's the right trade. And guys, it's just got to be rules met or rules not met. So I like that you guys are getting paid on these, but remember, we're creating muscle memory. We are creating muscle memory right now. I know, Joel, and your chart reads are 100%, and you get bored just like the rest of us sometimes. Kenny, I don't know what that is, brother. You might have to try again for me, Kenny. So let's do a live chart read. So this is crude oil, guys. Do we have momentum? What do you think? New users. Yes. Haven't quite hit the mid band. Large, no, you're okay. You're a new user. So let's do this just for grins. If I get a reversal bar right now, that's the bottom of my triggers. That's the top of my triggers. This is the lowest point of resistance. This is the highest point of resistance, guys. You have about a 16 or 17 tick stop at this point. And now as the market goes down, things begin to change. Suddenly, that resistance is out of the equation. Now my window of opportunity has decreased dramatically, and I think I just killed my charts. Yeah, I'm about to crash. There it goes. Let me pull that right back up. But the idea is that you can go through and look at your chart and look at it quickly and make these decisions about whether or not the advantages are there, pinpointing where the market is most likely to continue. And then the only other option is to wait and see, are your rules met? Does it follow your plan? And here we go. We're coming back through. Odds favorable momentum. It's loading up right now. Odds favorable. The mid band is only a termination if the large triggers are a full bar away. I'm looking for a reversal bar, and guys, this is my lowest point of resistance inside of favorable large triggers. Can you give me a Y if you see it? Starts with the momentum. Then we get the clear path. And guys, now all I need is the small crowd to fight. That's it. And this is what stinks, is they're either going to fight or they're not. I'll never be in control of that. But I know exactly where I want to enter this market if they fight. The rest of it's out of my hands, guys. Still confused on how it's considered a termination and not just two divergences. Why can't it be both, Gino? Let's talk about it. Let's talk about it. I'm going to go to the user guide too, Gina, to do this one. The buy limit is somehow at the mid-band? No, it's at a couple ticks below the area inside of favorable large triggers. Use the language, Tom. I need a pullback to an area inside of triggers. The only area I have is the mid-band. That's it. Large chart said look for an entry. Large chart's gone now. I'm looking for the small crowd. Does that make sense? Awesome. All right, so Gino, let's do this real quick. I love this. This is such a good lesson. And I'm going to show you something else. And this is such a common question, Gino, that I actually made a picture. Oh my gosh, this was, I don't even know when this picture was made. It was a long time ago. So termination conditions defined. They're Fibonacci-based indicators that may reverse the market based on a comparison of the Fibonacci area in the T3 triggers. Is everybody good with that? All a termination condition is, it's a line on the chart, and we're going to make a comparison of that line and the triggers. Gino, are you good with that concept? So it can be blue Fibonacci support, and it can be red Fibonacci resistance, and it can be yellow 1-to-1s, and it can be a cyan divergence low line, and it can be a magenta divergence high line. And the reason that these lines fit in, Gino, is because anytime the market has a divergence low or a divergence high, it represents a specific point, a to the tick point, where not only could the in control force, like buyers at a top or pushing it up, sellers at a low, not only could the buyers not push any further in that direction, but they also had their momentum stolen from them. So it behaves like a line in the sand, and that's why it fits into the termination conditions. Does that make sense? So these divergence lines, because they're such an impactful line that says, hey, this is where the market may stop. This is where things could end. The same way support does it. Price comes down and comes up, and it creates divergence. And this is just one divergence, and one divergence, Gino, is just a loss of momentum. But when price reaches that line and the divergence and the triggers stay above, now this line is the termination condition. Are you with me so far? And when a termination condition reverses the market, it's a strong bottom. So if we look at your picture, Gino, price reaches an area. Ooh, hold it. I just got a thought. So check this out. Let me take a picture of your picture real quick. Gino, what if there wasn't divergence there? What if it was just price reaches an area and the triggers don't break? Would that make sense to be a strong top? I'm wondering if you're getting hung up on the divergences and skipping the whole lesson on what it takes to create a termination and when that termination becomes a strong top or bottom. Does this make sense, everybody? Price reaches the divergence high, triggers remain below, it's a termination. When it reverses the market, it's a strong top. Is everybody with me here? So it can be anyone. It could be one-to-ones, it could be fibs, it could be a divergence high. The fact that there's a second divergence, Gino, all that does is it says not only did we lose momentum once at that exact price, we lost it again. But it doesn't change the rules for terminations. Price reaches a line, where are my triggers? If it reverses, it's a strong top. Does that make sense? I think you're getting hung up on the divergences and not the rules for termination conditions. Are you with me? Did I lose you? Did you say I don't have time to listen, I got to go take a trade? That one didn't work, did it? Notice that it's not favorable large triggers. Do you guys see it? The large and the synthetic separated. That favorable large trigger is no longer. Why what, Cheetah? Is it not favorable? So what are favorable large triggers? Hold on, let's go back to it. Great question. The old splits, right? Muser's been hurt before on this one. So Cheetah, favorable large triggers means that the large and the synthetic are one on top of the other. Does that make sense? And I hate okay. That means whatever. So let me show you something. If price returns to the large triggers, here's one place where price may return to. Here's a place where price may return to, right? See how they're not in the same spot? So what this tells me is that I just don't have any freaking idea. This is 100% indecision, right? There's two possible correction points. And when these separate, Cheetah, what it does is it lessens the likelihood. It really does. And one of the things that a lot of people do, Muser does this, that's why he mentioned the old splits. When my triggers are not favorable, when they are split, some users, the ones that hate getting run over because it's not perfect, wait for a reversal bar in the direction of their trade. If they don't get it, they don't enter. Morgan, remember when we talked about this, when you're saying when do I use a confirmation bar? When it's not perfect. Does that make sense, Cheetah? And this is why I talk about in the beginning, favorable large triggers, guys. Your advantage, your best entries, your highest probability, your lowest risk come from those stacked triggers. And man, when they start to separate, that indecision, what it does is it tells me, dude, market's not perfect. Look at the gap there. Your correction points aren't anywhere near one another. I get that it's odds favorable and it looks great, but let's wait for a little confirmation. And if you never get it, guys, you don't have to sacrifice, right? You know what your best look is. Are you worth it? I think you are. Well, the market changes, right, Cheetah? When we looked at price over here, it was all going up. And this is one of the things. You've got to be in the moment. You've got to be in the moment. Back here, Cheetah, it looked awesome. Look how close they are to one another. And the more it went down, oh, there's your reversal. Yeah. That's it. It's not a bad look. At the time of the reversal bar, that's not horrible, Cheetah. And that would have been your entry. And that would have been your stop. And it just didn't work. I see exactly what you're saying. Cool. That's it, Joel. And not a strong top, because it's not a termination that reversed the market, Muser. And guys, when we don't have a strong top, when that market is not coming from an area, that's a pretty common pattern. Continuation in the direction. Awesome, James. I love it when people that have experience show up, and you're not trying to reinvent the wheel, right? But most people find that Nexgen gives them a little something that they needed. So that's awesome. I love hearing that. And that's a pretty cool thing. I had zero experience coming in with Nexgen, so I didn't have any bad habits to break. I just had to create all new bad habits in a new platform. But I get it from a lot of people. You wanted to hate this program? Those are the best. Those are the absolute best. And James, man, I'm not mad at you for it. I wish everybody would come in hating this program or wanting to hate the program. One of the easiest ways to make clients is for you guys to prove me wrong. To actually learn it and study it and prove me wrong, and you'll be with me forever. And then James, as you learn to adapt it to whatever you're doing, let me know how I can help, guys. This classroom isn't just 101. It's not just remedial, right? It's all you guys that want to work on new things, different entries, different exits. I love talking about it. I love talking about it. Good stuff. Good stuff. And guys, we actually made it through all of the pictures. We've all seen how good the carpet cleaner is on TV. Rob, you've been hurt before, man. TV did you wrong at some point. Did you, Kenny? I'm sorry. You sure did. Thank you for that. And there will be times, right? Some of it's better, Rob. Nice 50-50, really a 75-25. You stayed out because of 3 divergences and price it didn't clear. Did I read that correctly? Absolutely, you did. They were in the rear view mirror. Trade was a nice runner. So, Kenny, let me show you something. And I love this because this kind of goes back to the thing. Look at where your arrow is. Do you see it? And on that bar, do you see what happened below your arrow, Kitty? Right into Fibonacci support, right? And look at this. That's the decisions being made right at Fibonacci support. That's the fight that happens right at this fib. And it says, Kenny, hold it for a second, brother. And then check it out. Once the triggers get below that 3rd divergence and everything is down, and now you're below the fib, maybe there's an opportunity to get down to the next fib. And this is just a matter of patience. Letting it sort out. When you start seeing these multiples, let the triggers start breaking back below it. Because 3 divergences doesn't always mean that the trend is over. Sometimes it just means that there's a huge fight. Let the fight end. Let it break. And then look for your opportunity, because your large chart always said down. Your small chart said pump the brakes just for a minute. Does that make sense, Kenny? Cool. And let me give you guys this picture too. I love giving pictures. One of the things that, because sometimes the market just doesn't go. right? We want it to go and it doesn't. So Kenny, this is one of those looks too. And for you guys that see that large chart and it never changes, right? You're like, oh, it's odds favorable and everything says down and those damn three divergences. There's a continuation, guys. Once these three divergences do what they're going to do and everything rolls and heads back up, there's still opportunity there. And sometimes it means patience, and sometimes it means that you got pulled out of the first trade, right? I'm in, third divergence, crap, I got to get out. But when everything rolls and everything says up again, maybe there's an opportunity. You were at the shootout at the Lake of Ozarks this weekend. Realize you need to get this working. What's the shootout at the Lake of the Ozarks? Sounds like a car thing. Kenny, do you see it? The divergences pushes you back, but everything says up. When those small triggers roll, man, a lot of times there's a second chance. When the large chart still says go. So I dropped that one in the room for you. And that would have been... Oh, boat show drag races? That'd be fun. And then run. Everything says down. Price clears trouble. Hop in. Waited for it 7 seconds. No time to avoid trouble. Odds favorable. Momentum galore. Football player trigs. Base hits by chili dogs. Absolutely beautiful, Ron. Absolutely beautiful. And you know what? This morning, Ron, I was channeling my inner Ron. And I took one and I said, you know what? I'm going to let it run. And I'm going to wait for Andy's reversal bar on the wrong side of the triggers to take me out. And it finally got me up there. That's a chili dog with extra onions. I learned that from you, though. My brother and I are playing with all sorts of stuff right now. We're sending so many pictures back and forth. Whoops, let me open up the S&P. All right, guys, we've made it through everybody's pictures. What do you guys want to talk about? We'll get that S&P loaded up. Morgan, let's see what you did. Was going to take this trade on the PA, but as soon as the divergence printed, you switched to Sim just to see it play out. That's a big hold. And yours is a 50-50, odds favorable. And you're from a strong top. So, Morgan, that was the perfect trade. I like that trade. You got one tick away. You put it on the other side of the area that may stop the market. Absolutely. James, it's MES. Man, that's what Sim is for, Morgan, is learning how to hold. So, James, one of the things you can do is check this out. So I've got the large ES, right? Weak triggers, fibs, multiple divergences. We're not going short. For people that want to trade micros, James, just put an M in front of that on your entry chart. And it's calculating right now. And we'll see what it looks like once it's done calculating. It's almost exactly the same. But I was talking to Kurt about this last week. So, James, the ES drives, right? The large ES drives. And these are the areas that we want to respect, is that key big player. But you can still execute over here if you wanted to take a long trade on the micro. You've got that micro long, right? You still have a large chart with a termination, with the small triggers rolling, couple divergences. So you can take that micro long and kind of mess with it and do it a little bit different. And this is one of the things that I think it's great if you're afraid of losing money. You had a question in the top right of that? I'm sorry. So that's one of the things that you can do. And you're not going to make a lot of money, James, but it keeps you focused on the process and not so much the money. I'm sorry, Morgan. You post this because you were curious if one of those moments where you would have used a reversal bar for confirmation. You know, Morgan, in hindsight, yeah, I don't know. With the strong top, with odds favorable, your only line is right here, right? And your stop placement is where it needs to go. So when my lines are up in the synthetics on something like this, I might still get into that area. You could wait for a reversal bar, but I'm not waiting for a reversal bar this far on the wrong side of everything. Look at where that is on the large chart. But that's 33, which means 37, which means you're like a tick off and you're right behind the 1-to-1s. And what happens, Morgan, is with a strong top, with that level of momentum, with everything saying down, do you want to trip over a couple pennies, right? There's a guy that trades, and he's been with us for a long time. On 50-50s with divergence, his entry, he'll take it at the highest point so that he has the least amount of risk. And that's his idea on it. He's like, you know what? I know that it's not high probability, but it's still areas inside of triggers. I'll get in at the one furthest away from the reversal bar. If it gets me cool, it's low risk. I like it. If it doesn't, whatever. I'm not going to worry about it. What's next, guys? Crude oil's just dancing now, right? They're trying to figure it out. Don't have momentum. My trigger lines don't agree. My trend is up. My large are down. My large are up. My synthetics are down. Just a little moment of indecision. Let them fight it out, guys. Let them fight it out. What do you want to talk about? Do we want to play the awkward silence game? I'm okay with it. Let's see what John Novak's doing. He says, hey Mark, check it out. When everything says down, the path is clear. You can get in and get out at fibs. Ron, does this look familiar? Guess what I've been talking to John Novak about? Where was Ron's trade? I guess I lost it. Just a bit. Anything fun this weekend? I did. I went to Austin, and my youngest turned 20 this weekend. So we went and took him and his brother out for hibachi, and it was a quick little turnaround, but we had fun. I don't know. There's so many things in the fire, Ron. Thanks, Tom. So many irons in the fire right now. Sure, Kenny. Drop it in. Of course I will. You know, Belt, I just don't like the Salt Lick. I know it's a whatchamacallit. Nice, Ron. It's like a staple, right? The original Salt Lick is much cooler. Yeah, their stuff is almost too sweet for me. They put too much sugar in their rub to try to get that bark. I don't care for it. It's not bad. And everybody should go to Salt Lick at least once. No, we did hibachi. That's my kid's favorite. Bunch of sushi and Fun stuff. Kenny, you can post it in here. Or you can also, Kenny, if you don't want to share what you're doing with the whole class, you can email it to me. Yeah, so back when I was a GM for Chewy's Tex-Mex, actually, I had a Rudy's up the road, and we would swap food all the time. I'd send them fajitas and enchiladas, and they would send me barbecue and cream corn and turkey and all that good stuff. I've eaten my weight in Rudy's 100 times over. Just transitioning, guys. That's all we're waiting for. Try and figure out what they want to do in crude. There's those large triggers way below the reversal bar marker. Right on, Morgan. Rudy's is good. And there's so much better barbecue than Rudy's too, but Rudy's is solid. Do you see the big division in the triggers? We're stuck in no man's land right now, guys. Stuck in no man's land. 90% of the day. You know, people always ask, Mark, can you trade live? Can you take trades live? And I always tell people, like, I can, but the rules have to be met. And if 90% of your day is spent reading indicators, guys, if you're waiting for me to say the rules are met, well, then we've got to wait. Texas Roadhouse, never had a bad steak there. And I do love Carolina barbecue. You guys have that mustard barbecue sauce. So stinking good. No more vacations for me until I get back to Austin. And we're still sitting. I'll tell you what, I want all of you guys to come up with one question. I'm going to take 5 minutes. I'm going to jump out of here. Go stretch my legs. When I come back, we'll get into the last hour. Make it a private lesson. There you go. I'm going to fly in Myrtle Beach for a private lesson. Guys, when I come back, drop your questions in the room while I'm gone. Let's see if we can cover some things. Exactly, right? How's business? And suddenly, the night out on the town is tax deductible. That's Buc-ee's. John P. Buc-ee's is the gas stations that are like Walmarts, and they've got barbecue in them. Buc-ee's are a magical place. If you've never been to one, make sure you have to go to the bathroom, though. It's the best bathrooms ever. We love Buc-ee's. We always stop. We stopped on the way to Austin. They have the best gummy bears, according to my kids. Hey, C-Dub. So, here's the question. Kenny, here's my question. Is your stop where you're going to put the stop, or is that giving you time to put it where the market shouldn't go? Because there's a big difference. 11 is an arbitrary number. And then you adjust. And you're looking for, on the ES, that is 2.5 points. That's a $250 trade, $225 trade. I love it. Why not? You're giving yourself reaction time, and then it's just 20 ticks, hell or high water, huh? In the beginning. It either hits it or it doesn't. And then trails tick for tick. Right on. How would I know that from this? I love it. Does it work for you? And that's the thing, man, is everybody's got their own stuff. And the only thing that I look at, honestly, Kenny, when people tell me what they're doing, is I want to make sure that you understand that that's not concrete. That gives you reaction time to put it where the market shouldn't go. So this is what I do. When people send me these, gives time to put stop where market shouldn't go, because that's always the rule. I don't care what kind of trade it is, where the market shouldn't go. And then that's your first target. Do you have exit conditions if things change on the way to 20? And this is it. So numbers are just numbers, right? What if 20 puts you 3 ticks beyond a fib? Well, then 20 makes more sense to be 17. Does that make sense, Kenny? So these are just numbers. And when you talk about a management plan, and then that's great. $150 is your stop loss. If you lose a trade, you're done. That doesn't leave any room. That doesn't leave you any room. I mean, if you're comfortable with it, what if you take the perfect trade and it loses? You just shut it down, no more? What if there's 75 great trades after? This is one of the things about trading, guys. $150. I'm teaching a buddy of mine to trade right now. And I said, you have to define your goals and your stop loss. He goes, well, I'm willing to lose $150 a day. And I said, then go back to selling cars. Because it's just not enough. You may have a $300 or $400 losing, but the key is, can you do more winners than losers? Okay, and that's cool to control your emotions. I like that then, Kenny. I like that you're using it to work through some emotional stuff, right? And when you get better with it, you may adjust it. But the 20, I like it. What if a third divergence prints, right? What if you hit a fib? Will you exit or will you hold it anyway? That's it. I like that. You'll bring the stop up, but you won't exit. So let me write this out. If I hit a fib, I'll bring my stop up, but not exit at that amazing, saw it from a mile away place where the market may stop. You'll just move your stop. Okay. So you're not willing to take chances on losers, but you're willing to bet the farm on hoping stuff breaks. Do you see the irony in that? Crude may not be the best example. I hit support. The triggers are way above it. Doesn't it make more sense to just get paid? Because what if it doesn't break? That's that what if monster that I think costs people a lot of money. But what if it breaks? What if this broken rules trade that I took ends up winning, right? So if that's your thing, then you're good. No, Joel, it doesn't. But I like where you're starting from. I like that you're starting from a place where you can put the stop where it doesn't go, and you're in the process of building, man. So being conservative, locking it in. One of the things that I tell people, and Kenny, it depends on your goals too. If you're using a trading firm, if you're in a trading firm, if you're using Apex or somebody with a trailing drawdown, getting paid at lines is an easier way to hold on to your accounts. If you're trading with your own money and you don't mind a little bit of drawdown, then that stop adjustment makes a lot of sense. So you got to know what you're up against. If you're in a trading firm, those loose stops and hoping stuff breaks will ultimately cost you. If 4 or 5 of them don't break in a row, because you're punished from your highest point of equity. Does that make sense? That's the part of the research that people don't do on trading firms. Okay, do they have a trailing drawdown? Or is it end of day? I think take profit is end of day, not from highest point of equity, end of day. So yeah, so you're cool then. Yours makes sense. Right on. And then when you pass, it's trailing. So be careful when it's trailing, because if you hit a line, right, and you are up, and this is how those work. And then C-Dub, I promise I'll get to yours. We're getting there. So the market goes down and hits a line, right? And I'm up $300 or $400. And I don't exit. And I only make $200. What happens is that my trailing drawdown is calculated from the highest open equity. So it trails from the 400 spot. Not the 200 winner. And this is what gets a lot of people, guys, on these prop firms, is they trade into a line and they're like, oh man, I hope it goes. And they get out break even and they think that they're fine, right? Man, have fun at the beach. And they think, oh, it's cool, it's just break even, but they lost $400 or $500 of their trailing equity, of their trailing drawdown. So that's why I bring that up, right? That's why I bring that up for you guys that are willing to hold into areas. There's a time to hope an area breaks, without a doubt. And then there's a time where it's just more advantageous to get paid. And you'll figure out, right? You'll figure out yours. But I think that your ATM strategy is solid in the beginning because you've put more thought into it than what just shows up on the ATM strategy. That was a lot of talking, right? All right. Oh, absolutely, Kenny. I love this stuff. And then you typed in there, this is just a realization that waiting for the triggers to break gives you a lot less stress. So can I reword that, C-Dub? Waiting for the triggers to break gives you a lot less stress. So this is trading into an area, and I love this. Trading into an area, EEK, I think is the technical term, right? Whoops. Trading from an area. Oh, you typed it too. I didn't even look down. That's awesome. But do you see the difference? Here I'm trading into a line. I hope it breaks. Here I'm trading from the other side of the line. I can't see anything between me and my target. And this is why we talk so heavily on those termination conditions, guys. And this is why they create such an advantage. And there's one other thing. Did you notice this? So everything's set up on your large chart, right? There's the back of your triggers. It didn't get outside of those trigger lines until it hit a line. That's that stop placement that James was talking about that's so effective. Understanding where the correction point is and making sure that your stops are on the other side. But yeah, trading from areas, C-Dub, instead of trading into areas. It's so much easier. Here's a good example. Don't trade into the area. Trade from the other side of the area. Right? Let it do its thing. That's why we don't trade into termination conditions. And here's the one thing, Kenny, that I think you'll realize the more time you spend with the software, and this is everybody will, is the more confident you get in your ability to find an entry, the more confident you get in your chart read, the more confident you get in being able to look at these indicators and understand where the market is likely to go, likely to stop, likely to continue, then the more inclined you are to get out at that line and just say to yourself, I'm going to find another trade. I know there's another trade. I've been doing this long enough. I'm going to get paid, and then I'll just wait. And you know what? If everything smashes through, I'll do what C-Dub did. I'll get paid at this line. I'll let them dance. And if it's really not going to stop, hell, I'll just get back in on the other side of the line. Does that make sense, Kenny? And that's one of the things that the accuracy does for us, is we know right where these bounces are likely to happen. You guys are good at this stuff. Odds favorable. What the hell is a 17-3 and an 8-2? What are you doing, C-Dub? Are these intentional? Okay. So, let me say this. Your question is, if I miss the first trade, should I take the next? Do you really read your charts like this blown up? That's wild to me. So this is what I do. And this is my answer, right? You should show them to me like you're looking at them, because there may be other factors playing into this that I can't see. Do I take the next entry on my small chart? That's pretty much what you're asking, right? But there's no areas up here. Those are just triggers. This fib is the only area that you have. That's the only basis, C-Dub. Are the rules still met on your large chart? Right? That was probably your best one. You missed it. And then it pulls back, but it's split triggers, so you're not sure where it's going to go. So how do you gauge? The further apart they get. So that's always my thing. Do I take another shot? If I miss the best shot, do I take another shot? If my rules are met, no. Now you just have split triggers, right? And you got a reversal bar, and that's just not a good look. But the fact that you have a fib right here at 35, but I don't see it right here, this isn't even a clear path. Right? And one of the things you did by adjusting your time frames is now you don't have synthetic fibs on your large chart. And 17 is not even a Fibonacci number. Why not go 21? So these are all the templates. 21-3 Renko bar chart. And then run that with your 8-2 entry chart. And then at least you're keeping in the Fibonacci sequence, and there's a little bit of Nexgen rhyme and rhythm put to it. Does that make sense? And what you've done at that point is you've just gone up a level from each chart. So it gives you that little higher time frame. So yeah, like a 21 and the 8-2, it's just one step up, which means your stops are a little bigger. It means that your moves are probably going to be a little bigger. And it's going to move a little bit slower. Does that make sense, C-Dub? Look at those split triggers, and it came back to the synthetics, right at support. Cool. Damn it, I killed it again. So yeah, when I see people just making up numbers, it worries me a little bit. 21 with the 8-2 will probably give you a smoother experience. So just right click and load that template. I notice things like this too when you guys show me charts. Like I'll notice if your synthetics are gone. I'll notice if your triggers look wonky. Um, and you'll get to the point where you do it too, where you're like, man, this just doesn't look right. We're going to pull this one back up. Sorry, I accidentally knocked it out. Let's say this continues to go short and break through the fib. Good question. So, Kenny, with the mid band hit and the large triggers a full bar away, does the mid band qualify as a termination condition? Okay. So if the mid band's a termination condition and it reverses the market, wouldn't that make it a strong top just by definition? It would. 100%, man. 100%. But what I see is all of my triggers up, all of them above support, right? I'm not even thinking about shorts yet. Shorts are so far off my radar right now. Kenny. I love that. But guys, I say almost every day that language is important. And if you commit not only to hoping to find a trade, but looking at rules being met, right? And having words to go with them. And if you took the time to memorize what's a strong top or bottom, it's a termination condition that reverses the market. Then it becomes pretty easy eventually. And this goes back to we all want to get to where we're going before we ever get in the car, right? We all want our trophy before we run the race. And you got to learn how to get there. Got to learn how to get there. Process yields results. All right, so I'm going to take that 5 minutes that I told you I was going to take 10 minutes ago. And when I come back, guys, drop a couple questions in here. Let's talk about whatever you want to talk about. I'll see you in just a couple minutes. All right, guys, let's get back. Kenny, this is why I say I don't try to anticipate strong tops or bottoms. Um, I'll literally just look at the market and say everything says up. I should probably look up. So Tom, do you see momentum up? Cool. So a momentum trade would be an opportunity to grab that little snap. Um, it is. Let me see if I can find one that is an actual momentum trade. Dun, 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 dun. This is it right here. Everything says down. The market is screaming. And what a momentum trade is anticipating the breakout of the area. So in a perfect world, your small triggers get through a fib or one-to-ones, and it's this quick little snapback. And it doesn't even have favorable large triggers a lot of the time. Let's see if we can find one. That would be a look like a momentum trade coming off at the top. Super strong little snapback. So it's not a trend trade. A trend trade has this big pullback. Momentum trades will be more of a, that's the look right there. So let's get the whole look on it. The rules for a momentum trade say when you have a termination, when the small triggers are up strong and the path is clear, let the small triggers break through an area, fibs, mid bands, yellow one-to-one, and you're going to trade that little snapback right to it, right at those triggers, and it's just momentum. So you can see that it doesn't last and it ends up retracing more. So these are quick little hits, but they start with a strong top or bottom. And we'll see. Maybe there was one off the bottom again. Just kind of that same look right there where it breaks through, snaps back. You need to be quick with your indicators. That's kind of the look right there. Snaps right back to the fib with everything going down. So you've got to be quick. And one of the biggest challenges on momentum trades, Tom, is that people try to take them without momentum. People try to take these trades with weak triggers, and people try to take these trades with the smalls on the wrong side of the large, and they try to take these trades when the smalls don't break through the area yet. So there's rules. So there are rules, and there's pictures, and you have to study, and you still can't trade into areas. Hey, Otter. Nice to meet you. Welcome to the room. You need a good top or bottom. So what it does, Tom, is it takes what you're learning from the high probability trend trade, termination conditions, momentum, and it's just giving you another opportunity to capitalize. Thanks, man. I don't mind explaining it at all. One of the best things to do is just go take pictures, right? So if I open up my large chart, we'll just do this right here. And I'll do this. I'll say, okay, I'm going to let this be my strong top, and I have to be sure that my small triggers roll. So let's go see what this looks like on a smaller, faster chart. Bum, 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 bum. So there's my strong top, and it never sets up all the way down to the fib. So it just didn't even get there. So Kenny, you're asking me, what do I do if my rules aren't met, right? Or are you asking me, how do I break my rules to get into the market? If I have strong triggers on a large chart, but the reversal happens with no fibs around, when it reverses on a small chart, do you just pick a spot and all four triggers? So Mark, your rules aren't met. How do you enter the trade? That's what you're asking me. You don't have a place for a bounce inside of triggers. How do you get into the trade? Kenny, I don't. And I know that's not the answer that you want. I just don't. I don't know where it's going to bounce. No, the triggers are where I expect price to come back to. If the triggers were the area for the bounce, wouldn't it have bounced here? Or maybe bounced right there, right? You know, the triggers are where I expect price to return to. The areas inside of triggers are what I expect it to bounce from. It's a good question. I know what you're saying. Do you have a picture of what you're talking about? I'm assuming it's happened recently. Let's use this one. Hold on. All right, so Kenny, you're like, all right, mid bands hit, but this was a term, right? And I'm thinking, because these triggers are up and these triggers are up, and this area is likely to hold right here at the triggers, but there's nothing on my small chart, but I really want to take that long, right? Is there any reason you couldn't try a reversal bar? I mean, you could. But Kenny, fibs aren't the only thing, are they? So it's fibs. There will always be a midband. And it's one-to-ones. So there's three areas. It doesn't have to be a fib. So if it goes short, if everything turns and it starts going down, that midband is always going to be there. The midband follows price. It's a moving average. But you've got triggers up, areas up, trend up, right? So if this goes short, what has to happen? Dude, you got to clear all sorts of stuff to take a short. You've got to roll the large triggers. You've got to get the smalls to the other side. Do you see how it's just so premature to even think shorts? I don't even consider that shorts are a possibility until my smalls get to the other side of my large triggers at least. Because the laws of termination conditions say if price reaches support and all the triggers are above, doesn't it make more sense that the market's likely to go up than down? Doesn't this become an area that's likely to stop the market? And one thing people do is they get sold on a direction. They get married to a trade. And that's tough. These are the questions you have when you're staring at these bad boys. Fibs, midbands, yellow one-to-ones, Kenny. That creates your highest chance of success. Do you know how you start taking the trades beyond? Oh, and you guys hate this. Is you have to go back and take pictures of what it is that you're curious of. And you have to ask yourself, does it win more than it loses? When you have strong triggers and a clear path, this is exactly how your study has to go. Circle a tail. There's your pullback, right? Are you good at that? Like when it looks like this, circle a tail. And when you circle that tail, what's it look like on the small chart? Well, there was still a fib right there. The mid band was in the middle. So what you do, Kenny, is you start compiling this database of what it looks like when it's not perfect. And you start saying to yourself, well, when the mid band is caught in between, maybe I can get a reversal bar off the bottom of those synthetics, right? Because that's where we expect price to correct to. So understanding that first concept from rule number 3 sets you up to maybe start finding a way to capitalize on the trades that aren't perfect. Does that make sense? Does that help a little bit? Yeah, they're just churning. You're done, Pete? Have a good one, man. Just waiting. Not a good top. Odds favorable. Room to target. I don't think I'll take it if it doesn't fill. I guess that makes sense. You're not going to take it if it doesn't fill. That's a big push, right? Crude oil's starting to work its way down. This divergence, though, just know that your mid band would be your first target. Mid band would be that first target. Let's open up crude. Let's take a look at it. So C-dub, that's what mine looks like on crude oil right now. Bad top, 1, 2, 3, 4 divergences. I'm not sure how long ago your picture was. Oh, you're using a different chart. You're using a 21 and the 8-2. Yeah, it's a big slow moving chart. I think that there's just, it's a big slow chart, man. If the 13.2 is slow, the 21.3 is slower. So I can't gauge based on this one. Show me a picture, Belt. I don't believe you. I think you're full of beans. I think gold has a bad top. Prove me wrong. There are no bad tops, guys. They're just misunderstood. Yeah, C-Dub, I have to remember that you're on a higher time frame. It's going to take me a minute. Yeah, it is, Belt. Look at that. Termination, full reversal, odds favorable, rock star entry, out at trouble, and then you get the next entry and you just broke even. I believe it. How come? Because you got weak triggers at a fib and multiple divergences. That says don't leave too much on the table, so Belt, great management. See how the small chart's telling you that this is likely to hold? Divergence, 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 divergence. I'm sorry. That's that damn typing. Divergence, 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 divergence. Guys, you're watching a fight. And it's all right at a fib, right? So this goes back to, Belt, were you in here earlier when we said it's easier to trade from an area instead of into an area? Or trading to the area. And once you get to that line, man, let it get to the other side. If it's going to break, it's going to break. And then you don't have to worry and wait. S&P is stuck. Crude's trying to figure it out. Belt's like, I'm taking some money out of gold. Guys, we got some time. What do you want to talk about? What's on your mind? Tom, have a good one, brother. Thank you for being here. Good questions today. And Kenny's going, man, Mark, I told you this was going down. The list of primary rules for high probability trend trading, KISS 50/50. No, Belt, I'm not smart enough for secondary rules or guidelines, to be honest with you. I find them confusing. I will give you this, though. This might be helpful. So this document is called exit conditions. Things you'll know before you sit down, right? Why you're getting it out. These are things that can mess up a trade. Right? These are the things. So there's some tidbits. But to be honest with you, Belt, the tidbits that you're asking for, here's management, right? It's all in the spreadsheet. Patterns that repeat themselves. Split triggers, 50/50 with divergence. Mid-band is a term. This says great chart reading and the content's no longer available. Isn't that a bummer? How's that for anticlimactic? Pivot from space, finish move. What does that mean? That means that when it's not a termination that reverses the market, these 50/50s are less likely to work. And you see that continuation up, and you see it a lot. So, Belt, I'll give you guys everything I have, like when I see it in the market. Triggers broke through, so it wasn't a strong bottom, which means the mid-band's likely to hold. Large triggers kind of help confirm it. You get the dance in between fibs. And then, Kenny, we'll see what happens, right? We got to see those fibs break. Got to see some indication that this support isn't going to be the end of the push down. Studying is preferable to typing. No worries. I type so fast, Belt, that typing doesn't faze me at all. And I took typing all through middle school and high school because it was easy. It was an easy A and I had to have electives. I had to take it in college. And my teacher, I asked her if I could test out, and she said no. And I said, what if I could type? And I think I did 85 words a minute. It was junior high back. God, it was junior high back then. You're absolutely right. Typing with photography, all the cameras broke, so you just typed in junior high. Yeah. It was weird. When I got to high school, here in North Dallas, they had them separated. It was 9th and 10th grade was separated from 11th and 12th. It wasn't like that in Houston. In Houston, it was terrifying walking in as an 82-pound freshman, and there were dudes with beards. Scary. Still scary. I still can't grow a beard. 52 years old. There we go. Why don't we trade in determination conditions? Because they can create a bounce. Crude oil's trying. Look at that fight. Whew. I don't know if it's up or down. A lot of patience today, guys. A lot of patience going on today. Whoa, what did I do? And guys, just a heads up, if you send me a message on Discord during class, I don't typically get it. All right. Knees and toes. Yeah, it is a little bit, isn't it? But it's right into yellow 1-to-1s with weak triggers. Oh, yep. 3 divergences, 4 divergences. Hold on. I'm looking at it on the wrong screen. That's a total termination condition, isn't it? Weak triggers at a fib. I love this one. Right to the area. You took another shot. I think if your shot would have been from here, could have made a little money before the divergences took you out. This is one of the things that hesitation does as well, guys, is the longer you wait to enter a trade, if it's in that same spot, it's less likely to work. It means that the fight has been going on long enough. The easiest trades typically go almost instantly. The more they dance in an area, the bigger the fight is, the less likely you are to be able to predict who's going to win. What do you think, guys? Somebody make me be smart real quick. Just waiting. You know, Tom Petty said that the waiting is the hardest part. I think he's right. Is it time to go swing golf clubs, go to the gym, have some lunch? My wife's working from home today. I can bug the hell out of her for a little bit. That'll teach her. What's up, Cam? Do you guys see Cam's in here? All of them, C-Dub. They all have their own personality, though. That's the thing. Man, what we do works anywhere. Watch this. Let's build a chart. What do you guys want to look at? Pick one, C-Dub. I'll build a 13-2. $6B? What is that? British Pound Futures. All right. Let's look at it. Ooh, gonna have to reload some historical on that one. Tony, sometimes your small triggers go unusually distant. Man, typically when they go unusually distant, Tony, it is, it's a glitch in data. F5 will rewrite your Ninja script, and usually that'll fix it. Or reloading historical data, usually that'll fix it. I know what you're talking about. I know the look that you're talking about. It's like your small triggers pull way away and it looks really weird. Changing the days really isn't it. Yeah, it's you just kind of have to rerun that script. I know exactly what you're talking about. All right, so C-Dub, here's that British pound. Pretty sketchy today, right? Not a whole lot going on. There's one of those momentum trades. With everything down and the path clear, it did pull right back to an area at the triggers. Oops. Yeah, I do have a template. So let's go back and see. Everything rolled there. I'm just looking this. I've never looked at the British. It doesn't look like it moves a lot, to be honest with you. That pulled right back. Look at that. Same pattern though. Odds favorable, potential to break from a termination that reversed the market. Right to resistance inside of triggers. So this is the cool thing about what we do. Is you can trade any market. You can trade Tesla, Apple, I don't care. I've got charts built for my wife. She's got some crypto accounts. And I built a workspace for her. And apparently I X'd out of it, so that doesn't work. So it works anywhere, C-Dub. I don't have any recommendations. If there's a market that you want to try, and you're like, I wonder if, right? Like, I wonder if 6B is a good one. I wonder if soybeans is something for me. I wonder if feeder cattle, orange juice, any of those. All you have to do is build the charts and scroll back and look and see if you find something. And then even better, because this goes faster, is do it on market replay and let it run through and see how they work. And this is one of the things, anytime I'm going to trade a new market or a new idea or a different management plan or a different approach to entry, or I'm trying to find patterns, guys, I'll market replay. I did about 5 days worth of market replay this weekend. Just practicing, making sure I understood, right? And sometimes I don't even trade. Sometimes I'll just open up a large chart on market replay and I'll look at the triggers and I'll look at the areas and I'll say likely to break, potential to break, gonna hold, right? And just all these things. But there's a million different markets, C-Dub. I don't really have any recommendations. If you're not getting what you need out of these two, it's probably not the market. If you can't find the trades you need in crude oil and the S&P, you probably have a weird plan, or you started creating higher time frames. And I don't know if there's markets that are better in higher time frames. One of the things that I always encourage you guys to do is, this is very much a community. And what you can do is you can go like to Traders Chat and post in there, NASDAQ's too fast. I agree. What is it that you are lacking, that you need more? Gold, I think, is very temperamental. Why not just take the best trade and add a couple contracts? Termination for the win, guys. You're gonna use smaller charts? Yeah, on those really big charts, you can't expect a lot of moves. And maybe that's it. You feel like you're not getting enough because you've gone to this higher time frame. Did you go higher because the small charts move too fast? I know a lot of people feel that way in the beginning. They're like, man, the market moves too fast, Mark. I can't keep up with it. And that's normal, and that's very natural. That's where taking a bajillion pictures pays dividends. Because once you know what you're looking for, it's like the market is standing still. All right, guys. So I'm going to